fueling the future venture studios and venture capitals defined. The world of startups is dynamic and brimming with potential. Yet turning innovative ideas into thriving businesses requires significant support, often in the form of funding and guidance. Two distinct entities play a crucial role in this journey: venture studios and venture capitals. Venture studios operate like startup factories. They generate ideas, build companies from scratch, and provide them with the necessary resources to flourish. These studios take an active role in the companies they create, often housing teams, offering operational support, and guiding strategic decisions. In contrast, venture capital firms act as investors. They identify promising startups and inject capital to fuel their growth. Unlike venture studios, they typically take a less hands-on approach, providing guidance and mentorship, while allowing the founding team to lead the charge. Both venture studios and venture capitals are instrumental in shaping the startup ecosystem. Understanding their unique approaches and strengths is crucial for entrepreneurs seeking the ideal partner for their venture. Building from within, the venture studio model. Venture studios operate on the principle of creating companies from the ground up. They are driven by a proactive approach, identifying market gaps and assembling dedicated teams to address them. Unlike traditional startups that often pivot based on market feedback, venture studios validate ideas and build minimum viable products, MVPs, before launching into the market. This approach minimizes risk by allowing studios to test and refine their concepts in a controlled environment. It also allows them to attract top talent by offering the stability of a well-structured organization and the excitement of building something new. Once a venture studio validates an idea and develops an MVP, it spins the company off as an independent entity. The studio typically retains equity and continues to provide guidance and support, ensuring a smooth transition into the market. This unique model has proven successful in nurturing innovative companies across various sectors. By combining entrepreneurial spirit with a structured approach, venture studios offer a compelling alternative to traditional startup incubation. Rocket Internet, a venture studio powerhouse. One of the most prominent examples of a successful venture studio is Rocket Internet. Founded in 2007, Rocket Internet gained recognition for its aggressive approach to building and scaling online businesses. The company focuses on replicating proven business models in emerging markets, leveraging its vast resources and operational expertise to gain a competitive edge. Rocket Internet's portfolio includes well-known companies like Zalando, a leading European fashion platform, and Lazada, a Southeast Asian e-commerce giant. The studio's success lies in its ability to rapidly launch and scale businesses, leveraging its global network and centralized resources. While Rocket Internet has faced criticism for its focus on cloning existing models, its impact on the startup ecosystem is undeniable. The company has played a significant role in shaping the e-commerce landscape in emerging markets and continues to be a dominant force in the venture studio space. Empowering innovation, the venture capital approach. Venture capital firms play a distinct role in the startup ecosystem. They act as catalysts for growth, providing funding and guidance to companies with high growth potential. Venture capitalists are often drawn to disruptive ideas and innovative business models that have the potential to redefine industries. Unlike venture studios that create companies from scratch, venture capitalists invest in existing startups that have demonstrated traction and a clear vision for the future. They typically invest in multiple companies across different sectors, diversifying their portfolios and mitigating risk. Venture capital investments come in different stages, from seed funding for early-stage startups to Series A, B, and C rounds for more established companies. Each stage represents a different level of risk and potential return, with early-stage investments carrying higher risk, but also the potential for outsized returns. Sequoia Capital stands as a testament to the transformative power of venture capital. Founded in 1972, Sequoia has consistently backed companies that have gone on to become global giants. Its portfolio reads like a who's who of the tech world, including Apple, Google, Cisco, Airbnb, and Stripe. Sequoia's success stems from its ability to identify and nurture companies with exceptional potential. The firm takes a long-term view on its investments, providing not just capital, but also mentorship, strategic guidance, and access to a vast network of industry experts. Sequoia's impact extends beyond its portfolio companies. The firm has played a pivotal role in shaping Silicon Valley and continues to be a driving force in the global technology landscape. Its unwavering commitment to innovation and its ability to identify game-changing companies make it a true icon in the world of venture capital. Investing in startups is inherently risky. The vast majority of startups fail, and even those that succeed often take years to generate substantial returns. This inherent risk is what makes the venture capital and venture studio models so unique. They embrace risk as an inherent part of the innovation process. Venture studios mitigate risk by controlling the early stages of company building. By validating ideas, building MVPs, and assembling experienced teams, studios can significantly increase the likelihood of success. However, this approach also limits the potential upside, as studios typically take a smaller equity stake in the companies they create. Venture capitalists, on the other hand, embrace a higher risk tolerance in pursuit of exponential returns. They invest in companies with the potential to disrupt industries and generate significant value, even if it means accepting a higher failure rate. The structured approach of venture studios allows for a more controlled approach to risk management. By testing ideas rigorously before launching into the market, studios can avoid costly mistakes and ensure they are building products that address real customer needs. This focus on validation and experimentation allows studios to iterate quickly and pivot when necessary. They can adjust their strategies based on market feedback, ensuring they are always on the right track. This iterative approach minimizes the risk of investing significant resources in an idea that ultimately fails to resonate with customers. Furthermore, by building companies in-house, studios can closely monitor progress and intervene when necessary. This hands-on approach ensures that companies are operating efficiently and adhering to the studio's overall vision. Venture capitalists operate on the understanding that high risk can lead to high rewards. They invest in companies with the potential to generate outsized returns, even if it means accepting a higher likelihood of failure. This calculated risk-taking is essential for driving innovation and fostering the growth of disruptive technologies. Venture capitalists mitigate risk through careful due diligence and portfolio diversification. They invest in companies across different sectors and stages of development, spreading their risk and increasing the likelihood that at least some of their investments will be successful. While venture capitalists acknowledge the inherent risk in their investments, they also recognize that the potential rewards can be transformative. By backing companies with the potential to disrupt industries, they are playing a crucial role in shaping the future. Access to capital is crucial for startups, but it's only one piece of the puzzle. To truly thrive, startups need more than just funding. They need access to expertise, networks, and ongoing support. Both venture studios and venture capitalists recognize this need and have developed unique ways to provide value beyond just financial investment. Venture studios offer a comprehensive support system that extends far beyond funding. They provide access to shared resources, such as legal, marketing, and HR expertise, allowing startups to focus on their core competencies. This holistic approach ensures that startups have the resources they need to navigate the challenges of building a successful business. Venture capitalists, while typically less hands-on than studios, leverage their extensive networks and industry expertise to provide valuable support. They connect startups with potential customers, partners, and advisors, opening doors that would otherwise be closed. From the moment a venture studio conceives an idea, it surrounds the nascent company with a comprehensive support system. This includes access to shared resources such as legal and accounting expertise, as well as marketing and sales support. By providing this infrastructure, studios allow startups to focus on product development and market validation without being bogged down by operational complexities. Moreover, venture studios often house their portfolio companies in the same physical space. This co-location fosters collaboration and knowledge sharing, creating a dynamic environment where entrepreneurs can learn from each other's experiences. The close proximity to the studio's management team also ensures that startups have access to guidance and mentorship whenever needed. This holistic approach to support is a key differentiator for venture studios. By providing not just funding, but also the infrastructure and guidance needed to succeed, studios significantly increase the likelihood of building successful and sustainable businesses. While venture capitalists may not be involved in the day-to-day operations of their portfolio companies, they provide invaluable support through their extensive networks and industry expertise. Venture capitalists have a deep understanding of the markets they invest in and can connect startups with potential customers, partners, and advisors. These connections can be invaluable for startups looking to gain traction in a competitive market. A warm introduction from a trusted investor can open doors that would otherwise remain closed, providing startups with a significant advantage. Furthermore, venture capitalists often have a wealth of experience in scaling businesses. They can provide strategic guidance on fundraising, product development, and go-to-market strategy, helping startups navigate the complexities of growth. The decision of whether to partner with a venture studio or a venture capitalist depends on the specific needs and goals of the entrepreneur. Venture studios offer a structured and supportive environment ideal for first-time entrepreneurs or those seeking to build a company from scratch. The studio's hands-on approach and access to shared resources can significantly reduce the risks associated with starting a business. Venture capitalists, on the other hand, are ideal for entrepreneurs who have already validated their idea and are seeking rapid growth. Their access to capital, networks, and expertise can help startups scale quickly and achieve their full potential. Ultimately, the best investment partner is one that aligns with the entrepreneur's vision, risk tolerance, and long-term goals. By carefully considering their options and understanding the unique strengths of each model, entrepreneurs can increase their chances of finding the perfect partner to fuel their journey to success.